Imagine walking into your own factory, right? And you just take a sledgehammer to the very machines that are currently printing your money.
Just completely destroying them.
Yeah, literally throwing them into a dumpster. You are intentionally halting your own production just to make physical room for a completely different type of machine.
And a very expensive machine at that.
Exactly. One that costs an absolute fortune to install, requires, entirely new plumbing and electrical work, and probably won't actually pay you a single dime for another year.
It sounds completely reckless.
It sounds like corporate sabotage, honestly. But it is exactly what a company called IREN is doing right now. And they're doing it on a multi-billion-dollar scale.
Yeah, it's a radical transformation. And, I mean, it perfectly illustrates the sheer gravitational pull of this current artificial intelligence boom.
Right.
Companies are willing to endure this severe, immediate financial pain if they think it's going to secure them a seat at the AI infrastructure table.
Well, welcome to today's deep dive. We are unpacking IREN, which is a company caught directly in the crosshairs of two of the most disruptive, chaotic, and heavily hyped tech trends of our generation.
Which is Bitcoin and artificial intelligence.
Bitcoin and AI, yeah. So they're attempting this massive strategic pivot, moving away from being a legacy Bitcoin mining operation and trying to become an AI cloud infrastructure provider.
Right, which is no small feat.
Definitely not. So our mission today is to look at the data for you and figure out whether this is, a visionary masterstroke that's going to pay off massively or just a total financial tightrope walk that's destined for disaster.
And we've got a lot of data to get through.
We do. We are pulling from a stack of equity research assessments, some live market data from FinHub, and these really sharply conflicting analyst reports from Morningstar and Motley Fool.
Yeah, and before we really get into the mechanics of this pivot, I think it's crucial to state that we are looking at some highly polarized viewpoints today.
Absolutely. Which brings up a necessary disclaimer for you, the listener. As we go through this deep dive, we are going to be discussing financial data, extremely bullish market valuations, and some brutally bearish critiques.
Very brutal.
Yeah. But we are strictly reporting the perspectives found in these sources. We aren't taking sides, we aren't endorsing any specific market view, and we are certainly not offering investment advice.
Right, we're just here to translate the reality of what the data is actually showing.
Exactly. And I mean, the data shows a company wrestling with this immense disconnect between its future promises and its present reality.
Yeah, to understand the controversy around IREN, you really have to look at the sheer scale of the target they've set for themselves.
Let's start with those headline numbers, because they definitely command attention. IREN has set a target of hitting $4 billion in annualized run rate revenue, ARR, by the end of calendar year 2026. $4 billion. And for context, this is a company that has historically dealt in just, fractions of that amount.
It is an incredibly ambitious target. I mean, ARR is essentially a way of measuring predictable recurring revenue over a 12-month period.
So forecasting $4 billion means you need a massive pipeline.
You need an ironclad pipeline of customers. You can't just guess that number.
Well, according to IREN, they have that pipeline. They claim to already have $3.1 billion of that $4 billion locked in and contracted.
Right.
The sources actually note they recently announced $2.8 billion in new multi-year customer contracts with some major AI developers. So if you just glance at the press releases, the future looks exceptionally bright.
Yeah, the revenue is supposedly guaranteed.
But then you open up their most recent earnings report and the narrative just kind of fractures.
It shatters, really. I mean, in the third quarter of their fiscal year 2026, their revenue didn't grow. It actually dropped sequentially.
It fell from $184.7 million down to $144.8 million.
Which is nearly a $40 million drop in a single quarter.
So for a listener trying to make sense of this, how does a company with over $3 billion in contracted future revenue lose $40 million in current revenue?
Well, this brings us right back to your opening scenario with the sledgehammer.
Right. The factory.
Yeah. IREN is actively turning off and decommissioning its old revenue-generating Bitcoin mining hardware. They are systematically unplugging the application-specific integrated circuits.
The ASICs.
Right, the ASICs that they use to mine Bitcoin.
So they are retrofitting the factory while still trying to pay the mortgage. But why not just run both? Why do they have to kill the Bitcoin miners to run the AI servers?
It comes down to the physical mechanics of data centers. A Bitcoin mining facility and an AI data center are fundamentally different beasts, even though, they both just house computers.
Okay, how so?
Well, Bitcoin mining is relatively simple. You have racks of these ASIC machines,
Yeah.
which basically act like giant space heaters calculating math
That
problems.
sounds hot.
It is. But to keep them from melting down, you just need massive fans pushing ambient air across them. It's air-cooled, and the networking requirements are pretty minimal.
So you just plug it in, blow a fan on it, and connect it to a basic internet line.
Essentially, yes.
Yeah.
But an AI data center is completely different. When you're installing millions of dollars worth of NVIDIA GPUs, the energy density is just staggering.
Because they work so much harder.
Exactly. A single rack of AI servers consumes so much electricity in such a small footprint that blowing air on it physically cannot carry the heat away fast enough.
Wow. Okay, so what's the solution?
You have to install complex liquid cooling systems. You're literally pumping chilled fluids directly to the chip plate.
Sounds like a plumbing nightmare.
It is. And furthermore, those GPUs need to talk to each other constantly to train AI models, which means you need massive bundles of fiber optic cables.
So you really can't just swap a Bitcoin miner for an AI server.
No, not at all. You have to completely replumb, rewire, and reinforce the entire building.
Which explains the Motley Fool critique perfectly. They point out this dangerous gap between signing a contract and actually getting paid.
Yes. Contracted ARR does not mean immediate recognized revenue.
Right. IREN can sign a multi-billion-dollar deal today, but they don't see a cent of that cloud revenue until the old Bitcoin miners are in the dumpster, the new liquid cooling pipes are welded, the GPUs are installed.
And the client is actually running their software.
Exactly.
And that is the central friction here, the execution gap. Right now, a significant portion of their current sales are still coming from the legacy Bitcoin mining that they're actively trying to phase out.
So they're basically suffocating their current cash flow to build the infrastructure for their future cash flow.
Precisely.
Okay, but if the wait time is that long and the transition is that messy, why are the biggest tech companies in the world signing on the dotted line with a former crypto miner?
It's a great question.
Because the customer list in these sources is, it's staggering. We're talking about a $9.7 billion contract with Microsoft, a $3.4 billion 5-year contract with NVIDIA itself, plus massive deals with AI developers like Perplexity and Figure AI.
Look, those companies are not signing with IREN out of charity.
No, definitely not.
They're signing because IREN controls the single most valuable, scarce resource in the entire technology sector right now.
Power.
Exactly. Power availability is the ultimate bottleneck for the global AI build-out. You can manufacture all the advanced silicon chips you want, but if you don't have a place to plug them into the electrical grid...
They're just really expensive paperweights.
Exactly. And you can't just drop a massive AI data center in the middle of a major city or a suburb.
Because the local utility grid literally couldn't handle that kind of localized draw without causing brownouts, right?
Right. But IREN has a 5-gigawatt global secured power portfolio.
5 gigawatts. Let me put that into perspective for you, the listener. 1 gigawatt of electricity is enough to power roughly 750,000 homes.
Which is huge.
Yeah. So IREN has secured the power capacity of a major metropolitan area, specifically zoned and approved for high-density computing.
And this is where their legacy as a Bitcoin miner flips from a liability into their greatest asset.
Oh, because they've already done the legwork.
Exactly. Years ago, to make Bitcoin mining profitable, these companies had to scour the globe for cheap, stranded energy. They negotiated complex grid interconnect agreements. They built custom electrical substations.
And probably waded through years of zoning laws.
Exactly. They already did the hardest, slowest part of building a data center, which is securing the electricity. The tech giants are happy to wait for IREN to install liquid cooling, because waiting for a brand new power substation to be approved by a utility company takes even longer.
That makes perfect sense. And to capitalize on that, the sources note IREN has actually expanded via acquisitions.
Right, they've been busy.
Yeah, they bought Nostrum, which adds 490 megawatts of power capacity in Spain, giving them a foothold in Europe. And they bought Mirantis, which provides software orchestration capabilities.
That Mirantis acquisition is vital, by the way.
Why is that?
Because having a building with electricity is just real estate. To be an AI cloud provider, you need a software layer that allows customers to seamlessly log in, rent compute time, deploy their models, and scale up or down.
So Mirantis gives them the software stack to actually operate as a cloud service, not just a landlord.
Exactly.
Now, here's where the power dynamic gets genuinely fascinating. NVIDIA isn't just a $3.4 billion customer here.
No, they're heavily invested.
Yeah. As part of their partnership, NVIDIA negotiated a 5-year right to purchase up to 30 million IREN shares at $70 each. That is potentially a $2.1 billion equity investment from the dominant chipmaker in the world.
It is a masterclass in strategic hedging by NVIDIA.
It kind of feels like NVIDIA is essentially underwriting IREN's survival just to ensure they have a place to plug in their own GPUs.
Well, NVIDIA knows they can't sell their next-generation chips if there are no data centers capable of powering them.
Right.
So they offer this massive financial lifeline, heavily incentivizing IREN to succeed, while also guaranteeing NVIDIA priority access to that coveted 5-gigawatt power portfolio.
So it secures the infrastructure required for NVIDIA's ecosystem to continue growing.
Yes, but
That's a but.
there's a big but. Despite these marquee mega contracts and having the most powerful friends in technology, the fundamental financial health of IREN presents a much darker, highly volatile picture.
Time for the bear case.
Yeah. The bear case here is substantial, and it revolves entirely around the cost of this transition.
Bleeding cash today for the promise of tomorrow. Let's look at the damage. In Q3 of their fiscal year 2026, IREN posted a widening net loss of $247.8 million.
Which is a huge hit.
The sources point out that $140.4 million of that was in something called non-cash impairments from scrapping that old mining gear. What does that actually mean for the company's health?
A non-cash impairment is essentially an accounting reality check. When they bought those Bitcoin ASIC machines years ago, they recorded them as valuable assets on their balance sheet.
Right, because they were making money.
But now, because they're ripping them out and throwing them away to make room for AI servers, those machines are suddenly worthless. They have to officially write down that loss in value.
So it doesn't mean $140 million physically left their bank account this quarter?
No, but it severely damages their profitability metrics and acknowledges a massive destruction of past capital.
Got it. And they also took a $23.7 million hit in unrealized losses on convertible notes. Let's translate that too.
Sure.
A convertible note is essentially a loan from investors that can eventually be converted into shares of the company's stock instead of being paid back in cash.
Correct.
If the stock price fluctuates, the perceived value of that debt changes, forcing the company to record an unrealized loss on their books.
Precisely. And the fact that they're issuing convertible notes at all is the core structural concern for the bears.
Because the transition to AI is just astronomically capital intensive.
Exactly. Now, the sources note that IREN has a massive liquidity buffer, about $7.6 billion in cash and cash equivalents.
Which sounds like a mountain of money. Most companies would absolutely kill for a $7 billion war chest.
It is a mountain, until you look at the price tag of what they're actually buying. Building out 5 gigawatts of liquid-cooled AI infrastructure requires tens of billions of dollars.
Wow.
Yeah. And the research shows that customer prepayments, like the money Microsoft or NVIDIA gives them up front, only covers about 45% of the required capital expenditure for the GPUs.
So that leaves a massive funding gap.
Right. Every time they sign a new data center contract, they're on the hook for the remaining 55% of the hardware costs.
Which is why they recently had to issue $2.6 billion in new convertible notes. Even with billions in the bank, they're taking on massive debt to fund this pivot.
And the bear argument is that until IREN starts recognizing meaningful, sustained AI cloud revenue, they're going to be forced into a continuous cycle of issuing debt or diluting their stock just to keep the lights on and the construction moving.
It's a treadmill they can't get off of. And this fundamental friction creates a really stark divide among analysts. We have 2 reports from Morningstar in the source stack, and, I mean, they read like they are evaluating completely different companies.
It's pretty wild.
One report praises IREN's data center build-out roadmap, calling their strategy highly promising given the macro demand for power.
In the opposing view.
The other report brutally labels IREN and also ran in the AI cloud space.
Ouch.
Yeah. They argue the shares are drastically overvalued and that IREN is suffering from severe operational growing pains.
That also ran critique cuts right to the heart of their competitive positioning. IREN is not operating in a vacuum here.
Right, they've got rivals.
Big ones. They're attempting to compete against established hyperscalers, massive legacy providers like Amazon Web Services and Google Cloud, as well as specialized neoclouds.
A neocloud being a newer cloud provider built exclusively from the ground up to handle AI workloads, right? Unlike the older companies that are trying to adapt their existing servers.
Correct. And even among their direct peers, other converted crypto miners, the competition is fierce.
Who else is doing this?
Well, the sources point to a recent note from Bernstein Research that actually favored a competitor named TeraWulf over IREN, specifically regarding their data center operations in Texas.
So just having a building and a massive electrical connection isn't enough to win?
No, it's merely the price of admission. The Morningstar critique is really questioning IREN's operational maturity. Yes, you have the electricity, but do you have the flawless software integration, the network security, and the guaranteed uptime of, say, a Microsoft Azure?
Right.
If they struggle with the software side, despite that Mirantis acquisition, they risk being relegated to a mere commodity provider, just a digital landlord renting out cooled space rather than a high-margin technology partner.
So if you are a listener trying to evaluate this, you have massive multi-billion-dollar future contracts and unparalleled power assets on one hand.
Whole case.
Yeah. And on the other, you have intense cash burn, crippling physical execution delays, and brutal competition.
The bear case.
Exactly. So how is the stock market actually processing this fundamental conflict?
Basically by oscillating wildly between extreme optimism and extreme panic.
Yeah, the technical whiplash on the FinHub Live data is intense. IREN stock is down 46.4% from its 52-week high, which indicates a massive sell-off. Yet simultaneously, it is up 122% from its 52-week low.
That kind of dramatic spread indicates deep, deep market uncertainty. Investors are aggressively repricing the company with every new headline.
They can't make up their minds.
Right. They're unable to decide if they're valuing the $4 billion future or the $247 million quarterly loss.
And to measure that anxiety, we can look at its beta. IREN has an extreme beta of 4.31.
Which is very high.
Very high. To explain that simply for you, a beta of 1 means the stock moves in lockstep with the broader market. A beta of 4.31 means that if the overall stock market drops by 1% on a Tuesday, IREN stock is likely to plummet by over 4%.
The volatility is heavily leveraged.
Totally. And yet, despite being down 46% from its highs, it is still priced for absolute perfection, trading at a price-to-earnings ratio of 191.
A PE ratio that high confirms that anyone buying the stock today is entirely ignoring current earnings.
Right.
They're betting exclusively on the successful execution of that $4 billion annualized run rate target.
But amidst all this technical chaos and market anxiety, there is one speculative catalyst in the research that stands out above everything else: insider buying.
It is arguably the most compelling data point in the entire equity assessment.
Over a 90-day period, insiders at IREN, we're talking the executives and board members who actually run the company, bought a staggering 19,358,358 shares.
19 million.
Yeah. This happened across 9 separate transactions, and during that same 90-day period, 0 sells.
That is a highly concentrated, massive bet by the individuals with the most intimate knowledge of the company's daily operations.
They know the supply chains, the construction progress.
Exactly. It is a fascinating psychological signal.
Because the broader market is pricing in severe execution risk, knocking the stock down almost 50% from its peak. Yet, the people steering the ship just bought 19 million shares.
Right.
It's like a real estate developer buying the top 3 penthouses in their own skyscraper, using their own money, while the market is loudly whispering that the foundation is cracked.
That's a great way to put it.
So, does this prove the foundation is fine? Are the insiders just irrationally confident, or is this absolute proof that the $4 billion in revenue is a lock?
Well, it undeniably creates a psychological floor for the stock price. I mean, when management buys 19 million shares while the price is dropping, they are sending a deliberate, deafening signal to Wall Street.
Like, we see the internal data, and we believe the revenue pipeline is secure.
Exactly. It forces short sellers to think twice.
Because they're putting their own capital on the line.
Yes, but, and this is a big but, we must separate belief from physics. Yeah. Insider confidence, no matter how financially substantial, does not eliminate the very real, very complex execution risk. Buying stock is easy. Physically installing thousands of liquid-cooled GPUs, integrating them with complex orchestration software, and achieving perfect uptime on a tight corporate schedule, that is incredibly difficult.
So management's belief does not build data centers.
Flawless engineering does.
Okay, so for you, the listener, watching this massive holding pattern, you've got wild volatility, big debts, big contracts, and insiders buying up everything in sight. What exactly should you be looking for next to see whether the bulls or the bears are right? How does this resolve?
There are a series of highly specific catalysts on the horizon that are going to permanently define IREN's narrative. The turning point is approaching.
All right, let's go through them. First on the timeline is their Q4 fiscal year 2026 earnings expected in August. What is the key metric to watch there?
That earnings print will be the ultimate early indicator of execution. We need to see a quarter where their recognized AI cloud revenue finally surpasses their legacy Bitcoin mining revenue.
Okay.
That crossover point proves a pivot is actually taking hold. Additionally, the market will be hyper-focused on their adjusted EBITDA.
Adjusted EBITDA being a way to measure their core operational profitability, right? Stripping out the weird accounting noise like those non-cash impairments from the dumped Bitcoin miners.
Exactly. We need to see that adjusted EBITDA return to sequential growth, proving that the underlying cloud business can actually generate cash, rather than the sharp decline we saw in Q3.
Makes sense. Then we move from the balance sheet to the physical build-out. IREN is targeting the delivery of their Horizon 1 through 4 data centers at their Childress facility by year-end.
Delivering that specific infrastructure on time is absolutely critical.
Why that one specifically?
Because it is required to de-risk that massive $9.7 billion contract with Microsoft. In the cloud infrastructure world, delays are fatal. If that delivery timeline slips, Microsoft has other options.
And the market will punish IREN's stock severely.
Without a doubt.
And speaking of timeline slipping, there is the NVIDIA contract ramp. IREN is targeting early 2027 to deploy air-cooled Blackwell GPUs for that $3.4 billion deal.
I would monitor this one very, very closely.
Why is that?
The analyst sources note there is high speculative risk regarding this timeline. Blackwell is NVIDIA's newest, most complex chip architecture.
So it's hard to get right.
Very. Deploying next-generation hardware at that scale is notoriously difficult. It's plagued by supply chain bottlenecks and unforeseen engineering hurdles. A timeline of early 2027 could very easily slip to late 2027.
And any delay pushes back the recognition of that desperately needed revenue.
Exactly.
Finally, we have to look outside the company at the macro factors. The sources specifically highlight legislative uncertainty regarding both crypto and data center regulations, particularly in the state of Texas, where IREN operates heavily.
Texas has historically been a safe haven for data centers due to its deregulated energy market. However, the Texas power grid ERCOT is under immense, unprecedented strain.
From the population growth and these crazy new AI facilities.
Precisely.
And if the grid fails during a summer heat wave, the political blowback is going to be immediate.
Oh, absolutely. Any new state regulations capping power usage or sudden audits regarding data center efficiency could create immediate headwinds for operators like IREN.
Even if they already have secured power interconnect agreements.
Yes. Political reality can override those contracts if the grid faces a crisis.
Wow. Okay, so we have unpacked the grand pivot, the marquee contracts, the massive cash burn, and the wild market signals. When you synthesize all of this data, where does it really leave us?
It leaves us in a highly cautious wait-and-see stance. The contracted backlog, that $3.1 billion in locked deals, is real.
Yeah.
The relationships with Microsoft and NVIDIA are real, and the 5-gigawatt power portfolio is an undeniably scarce, valuable asset.
The potential is clearly there.
But the execution gap is immense.
Okay.
The physical transition is financially painful, and their current elevated valuation multiple leaves absolutely zero room for error.
So if they stumble on deployment, or if the software integration fails,
the fall from a PE of 191 will be steep and unforgiving.
It's a multi-billion-dollar high-wire act. And it brings up one final provocative thought I want to leave you with. Something that wasn't explicitly spelled out in the analyst reports, but kind of feels like the inevitable endgame of this entire industry shift.
Okay, what's the endgame?
If IREN successfully bridges this gap, they prove a fascinating historical point, right? The massive global build-out of crypto mining infrastructure over the last decade wasn't a waste of capital. It was actually just phase one of the AI revolution.
That's a really interesting way to look at it.
They pre-built the power grid the AI companies now desperately need. But if securing massive amounts of power is truly the only major bottleneck for AI right now, what stops the massive hyperscalers, the Microsofts, the Amazons, the Googles, from eventually just acquiring these converted miners outright?
Rather than renting the infrastructure, they just buy the landlord.
Exactly. Right now, Microsoft is renting space from IREN, but Microsoft has trillions of dollars in market cap. Once IREN does all the hard, gritty work of securing the grid, retrofitting the cooling, and building the physical footprint, are they actually building a sustainable, independent cloud business? Or are companies like IREN just fattening up their power grids, packaging them neatly with a bow for an inevitable, massive acquisition by the tech giants? Are they the final destination or just the highway? It's something to deeply consider as we watch this market evolve.
It is the ultimate question of the infrastructure boom.
Yeah.
It's definitely a fascinating dynamic to watch in the coming quarters.
It really is. Thank you for joining us on this deep dive into IREN. We will be keeping a close eye on that August earnings report, and we'll catch you on the next one.